All right, cool beans. Oh, live stream too. Okay, cool. All right, getting a little bit of exposure. All right, sweet. So talking about house hacking and taxes tonight. So the agenda will be going, over expenses, pro rata rules regarding house hacking, your cost basis that you should keep track of, and what to add or subtract from your cost basis when you're house hacking, depreciation, and possibly using cost segregation with it, and talking about the homeowners exclusion will be the agenda. Quick slide, who we are, CPA dude, don't know. Yeah, I think most folks know, but if not, we're a tax planning strategy firm. And we use taxes, it can be a double-edged sword. It can be how we keep it simple, stupid method. So that's the KISS method. So we just want to keep taxes simple, even though they can be a headache, and we help people across all 50 states. So diving right into it. So about house hacking. So when you're house hacking here, what expenses can you take? So some examples that you want to keep in mind is, if you're doing any ads to get people into the door, cleaning that you're going to have, repairs on the house in itself, if anything gets ruined, or if you just want to make some updates, landscaping, insurance that you're going to have, mortgage interest, points if you pay anything, property taxes, electricity, water, gas, all your utilities, internet, I can't spell, legal and professionals, supplies, and HOA fees. So those are expenses that you can write off within the current year. However, there are some expenses that are like outflows of money that you cannot write off in the current year, like improvements. So improvements like adding a fence or, painting, the whole exterior of the house, those things that kind of extend the useful life. Those are improvements instead of improvements being expensed in year one. You have to, depreciate it over its useful life. So whether it's 5-year, 7-year, 15-year property, you have to space it out against it. And then the methods of like how you can, like, how much of it can you write off? So say if you have $10,000 in mortgage interest, like how much of that do you write off against the Schedule E, which is the rental side? And then also how much can you write off from like the itemized deduction side? And a couple methods that we recommend is, there can be the rented rooms divided by your total rooms. So if you have like a 4-bedroom house, and actually I have an example, I'll dive into that. Rental square footage divided by total square footage. So a couple of easy methods that you can use to divide out and prorate it. So let's use one as an example here. So the methods that we got the room method. So you got 2 rented rooms divided by 4 total rooms. So 50%. So take 50% of all these expenses up top, and those can reduce your rent that you collect. Next would be your square foot method. So say you have a 1,100 square foot house and you're renting out 600 square foot of that. So that's going to be like rooms, probably do a little bit of common spaces if you want. And that's like 54% in this example. So once again, you can take 54% of all this. So it depends on like how accurate and how conservative or how aggressive you want to be in terms of determining which method you want to use. So that's going to be just the expenses that you can have with it and which to keep track of while you're doing house hacking. So easy way to, keep your expenses tracked, either put in a Google sheet, use something like Wave Apps, QuickBooks, that's some type of like bookkeeping. So when you do your taxes next year, that's, an easy way you can rip it out and then you'll be able to not scramble. So hardest part about just the house hacks is, I would just say, your expense record keeping. Most people just don't do it until it's like, oh, year end. And then, you'll try to like rip together everything and a lot of things get missed. So just keep track of like the expenses as you're doing your house hack here. So the next part while you're house hacking would be your purchase price of your home. That's your initial starting place for your home. So that's going to be the cost. Closing costs also increase your basis. So when you increase your basis, you're just adding more of how much you could potentially depreciate. So closing costs, such as the title fees, points included, well, points you get an expense too. Prepaids that you have also on that side. So closing costs will increase your overall basis. Improvements also increase the basis of your home. So like an example, like if you replace your roof, you replace your kitchen, HVAC. So any big improvements, once again, improvements, you can always keep it and think about it as like, if I were to ever rip this out of my house, would it like material damage the house? And if it does like damage the house or change the use of it, it's generally an improvement. If it's not, then it would be an expense. So once again, improvements increase the cost basis, and then depreciation reduces your cost basis each year, and cost segregations can also reduce your cost basis of your house. So for example, here for depreciation purposes, calculating what your cost basis is say if you bought a $500,000 home and then you do want to strip out land. So when I say purchase price of a home, take out land, so about 20%. And that would be $400,000 is your starting cost basis. And next would be your closing cost. So say you added in, another 10 grand of closing costs before 10. And then next would be your improvements. So say you had a new roof was 20 and a new kitchen 20. So that's 40,000 here. And this is your starting base for your cost basis. So $450,000, this is like technically how you're going to calculate depreciation, is add up everything that goes to your cost basis. And in our example here, you have $450,000. And next would be that you just divide it by 27.5. And this is the total amount of depreciation that you can take before the pro rata. So these kind of go hand in hand. So it's like, if this is a normal long-term rental property or short-term rental property, you'd be able to take $16,000 of depreciation each year against it. However, you do need to prorate the amount because you're doing a house hack. So let's just use the room method since it's super easy here. And of the 16 grand on a $450,000 home times 0.5. So you would take $8,000 of depreciation each year against your rental income. So, a good way to get your rents more or less tax-free, gives you some leeway. So if you're house hacking, it could be, you have $8,000 of a non-cash expense. So that would be your depreciation side. So that's, and then please note that this does reduce your cost basis each year. So for example, in our we had $450,000 as our starting place, and just you get subtract out $8,000 each year from there, and it just keeps on rolling down and down and down and down. So when you do sell the property, this does actually affect you. So just keep that in mind, especially if you know that your property is going to have a big profit to it. You want to be mindful of it, and also that's another time to pull in a 1031 exchange, possibly. So on the cost basis, another part that could supercharge the depreciation against for you would be your cost segregation. So simply put, a cost segregation is just a study that separates your house components. So it needed to separate the 27.5-year property into smaller components. So your 5-year, 7-year, 15-year property. And then that way, since your denominator is lower, you're accelerating your depreciation. And then as a bonus, for a bonus depreciation in year one, if you bought your house and then you're house hacking it, you can run bonus depreciation against it. And that way you'll be able to take more of the benefit up in the first year. So on that would be, on a cost seg method here, you would have, let's see here. So cost seg method, how I just want to show you, like, if you do like a cost segregation, what's the different benefits that you can see. So on that 500K home, using that as a simple example here, you would have a purchase price of 500,000, land of 100,000. So then your building value is 400,000. So taking that again, we've had about 14.5K of depreciation that you'd be able to take normally. Obviously, you do want to take into account the amounts of your pro rata amount again. So 50, 54%, whatever's going to make the most sense for you, and also how aggressive you want to get. But say you get 7.25 in this example here. And then now number two is that now you actually ran a cost segregation report. And on that cost segregation report, you now have shifted, we have the same purchase price, the land still the same, but now your building, you can tell that it's a little bit different here. So the building is 400 here, but adding these three amounts, it's still 400. But simply put, what we did was that we shifted $70,000 of this into, 50 of it went to 5-year, 20 of it went to 7-year property. So what this is going to do, like I said right here, is that now the denominator is lower than 27.5. It's going to accelerate your depreciation. So on that note here is that you'd be able to take 24.8K of, your starting base depreciation before you prorate the amount that you want. So once again, 50%. So here that'd be 12.2K that you could take for accelerated depreciation. And then lastly is that, if you bought the house in the current year and you place it in service and you're renting it out, you can take bonus depreciation. And what bonus depreciation allows you to do, setting it up again, is that same 500K house, 100K of land. And now that's very similar to accelerated depreciation, but how the 50 and 20K happen is that you're able to take 80% of it this year. So 80% of 50K, 80% of 20K, and then you're able to fast track more of it. So you have 70.5K of depreciation that you can take times your pro rata amount. So this is a good way to lock in a good amount of losses, just in case your house hack is very profitable. You don't have as many expenses to offset items because your place doesn't get ruined from normal renting. So that's a good way to think about it. Cost seg studies do run, a pretty penny. So evaluate if it is right for you. It's not like a one size fits all type of answer. So cost segregation is useful, good tool in toolbox, just see if it's going to be right for you. So, examples of when it is better than other situations is that number one, it's you're doing like more, midterm or short-term renting where the profit margins are a lot higher. So you need more depreciation to offset that income. Number two, someone's real estate professional status that will always, feed more losses against your active income. And then number three, so and then, number three is that, if you are, under $150,000 of adjusted gross income, running a cost segregation would help because you're available to take the mom and pop rule. So what that allows you to do is that if you make less than 150K, losses against your rentals, because you're actively managing it because you live there, you can offset against your W-2 income. So that's another way to fast track more of the income or the losses against your income. And then just one big consideration to note, like on the homeowner's exclusion part, is that you have your property, you may have used a lot of depreciation against here, and this could have lowered your basis. So your basis is now depleted. So say if you had that home, so in our example, calculator again, we had our original example at $450,000, and then you had 10 years worth. So you had 10 years worth of depreciation added up, and we said you rented out half your home. So that would be, 80,000 that you have to strip away from your cost basis. So your cost basis is only 370, but in a 10-year time span, say it's now worth $1 million, and you sell it. Now you have a $630,000 potential gain. So what can you do to do with it? And you're still living there, you're house hacking it, is to deploy your homeowner's exclusion. So this would be 250K if you're single, or 500K if you're married. So hopefully, 10 years later, hypothetical, you are married, so you can take advantage of the 500K. So it would reduce your tax liability. But in order to qualify, you have to have, 2 of 5 years as your main rules, that, in the last 2 of 5 years, you've used / lived in the property and you have owned it for that case. You could get, say it's year 9 and, you sell them year 10, you could end up spouse, like your significant other, has lived with you. If you get married that same year, actually I have some people that randomly do this. They have a huge cap gain and then they're like, okay, let's go get married to like their partner of like 20 years. Had someone do that last year, actually. So the only part that they have to do is that they have to live in it. for the last 2 years to qualify. They can't just have moved in and be like, oh, hey, we got married. Okay, let's get the 500K exemption. So that's a good way to shield your capital gains from the property in itself. And then there are partial exclusions too. So from a partial exclusion side, they like, even though you won't say you just, I don't know, you're some big up and coming hot shot, you like move to Seattle because you're like in the woods, kind of, enjoy your life. And then like, boom, you got called into like New York, Wall Street or something. And then you're like, oh shit, okay, now I gotta sell my home. Like, and then you're like, oh, I got a big capital gain. But you can actually deploy the partial exclusion for this because you move for work. You can't just move for fun. You move for work and then, or you had like an extraordinary cause, right? Like parent got sick, you have to pick up all your crap and move and take care of them. So how the partial exclusion works here is that, for example, you had, let's just say you're married, right? 500K, and you live there for 12 months, 12 months of the 24 months. So live there 25 or 50% of the time. You're able to actually take half of the exclusion against it, even though you didn't fully meet the full-time period. So in this example, you'd be able to take, 250K if you're married, even though you only lived and owned there for 12 months of the past period. So partial exclusions, very overlooked. And I see a lot of like mistakes that happen, with the partial exclusions when people do move. So it's like you always, especially for house hacks that I've noticed is that, a lot of people will stay in it and then either one, they'll sell it and then they'll have a big capital gain, but it's like, what are ways that you can fight it? And then number two, a lot of folks do end up moving out of the current place. And then it's like, hey, what needs to happen when you fully rent out the property? And the only thing that's going to really happen when you do leave the property fully is just your method changes more or less. Obviously it'll just go 100%. You won't be able to deploy, let's see here, bonus depreciation because you replace that asset in use already. So you'll lose out a little bit on there. And then lastly, if you do decide to like partially live, partially sell, and you don't want to, and you don't qualify fully for the homeowner's exclusion, you could look into 1031 exchanging that partial piece of that home. So you had a duplex, and one side was rented, and you live in the other side, you could take the homeowner's exclusion on one side, and then on the other side, you could 1031 exchange that one too. So just another way to get creative if you do decide to sell your home. Then again, I don't think anyone's selling homes in in today's market because interest rates are so bad. So yeah, house hacking, it's not terribly bad. Hard on taxes. Biggest thing I would say, to recap is like, have your expenses, do them throughout the current year, and actually like keep tally of it. Use Wave apps, Stessa, QuickBooks, just track it, spreadsheet. Choose your method on how you want to use it. I got some folks from the square foot method that try to count common areas along with the two more on the aggressive side. Got some folks who just count the rooms. So just think about which method, or you just do the room method. Just have some qualified method. Cost basis, just keep track of it. Once again, like on that same spreadsheet or on your Wave apps, for example, QuickBooks, you can actually track your cost basis because technically it's an asset and it's a balance sheet item. So run this house hack like it was a real business. Consider a cost seg if it makes sense. And then if you're going to sell the property, consider 1031 exchanges or do a homeowner's exclusion or just pay the capital gains on it. So kind of up to you on what you want to do on that side. But yeah, pretty easy, pretty straightforward. But yeah, if anyone's got any questions, feel free to ask away.
Thank you. I had a question, Tony. This is Michelle. I might be, obviously, this is not my expert area, so this might not even be a legitimate question, but how does house hacking work with something like an STR loophole?
Yeah, so on the STR loophole, we do have folks that do it. So it's actually like quite easy and powerful to use. So the biggest thing is that you do want to make sure it's like a dedicated space. So what I mean by a dedicated space for tax purposes is that, whether it's like an in-law unit or it's like a lower unit, upper unit, or simply, it's 2 rooms of the house that's always for STR loophole. And what you can do with it is that, obviously it'll be super easy to actually meet the hours. So your 100 hours or more, or 500 hours, anyone can work more than you, those 2 prongs, or you substantially do everything because you live there. Documentation from hours is actually super easy because of a house hack. And then number 2, just make sure that you have the average of 7 days or less. And then from a method perspective, it's, obviously you want to get more like bang for the buck against your W-2 income. So, allocate per the room method or allocate towards the square foot method. And then, yeah, for yourself, you definitely want to run the cost seg because you want to run that bonus depreciation against your W-2 income. So it's, really good to do, especially if you're house hacking and doing an STR at the same time.
Thank you.
Yep. Good question. Yeah.
Hey Tony, can you hear me?
Oh, yeah.
Hey, this is Josh here.
Hey, what's up, man?
Hey, so thanks for the presentation. And I have a question. So if I if I'm in a situation where I'm buying a single family home, or actually single family home or multifamily 2 to 4 unit every year as a primary residence, so that I can live in it for 1 year and get another mortgage as a primary residence for the second one and third and fourth year after year. In that situation, from a tax perspective, after leaving the current primary residence and moving into the new primary residence, does the previous one and the ones before that I moved out of, are those now classified as investment properties?
Be classified as so generally from a tax perspective, when you leave a property, like how do you get it to be considered an investment unit? Is that generally it's shown on your Schedule E. So like you rented out the place, and then you have the proof and documentation on your Schedule E to show that it's an investment property.
Mm,
Yep.
I see. Okay.
Yeah. And then generally too, from not only from like a lease to show the IRS, but then another thing that you do want to show is like the switch, right? So like, you went from property 1 to property 2, you actually like change your license, you change like your voter registration, you change like all your bills and utilities. Because that's one of the things to substantiate like a notice or an audit, is that the IRS does look a lot at those records. So like where your bank records are, where your utility records are, where your voter registration and your IDs are. So yeah, that's another thing. And then one thing to keep in mind too is that if you're house hopping behind all these houses, is like when do you want to deploy your homeowners exclusion, right? Because you do have to live there 2 or 5 years. So I'm not sure like what your strategy is, but if you do ever want to sell 1 year, you do have the option to go back and live there for another year. So this 2 of 5 years, it doesn't mean it has to be consecutive 2 years that you have to live there. You can like live there for a year like you're doing, roll out for a year, and then you can come back for a year, live there, and then just you can sell it afterwards and still qualify for this.
Oh, okay. But the substantiation to justify that in the event of an audit would be the name on the bills for the utility bills, voter registration, IDs, right?
Yeah, they take a host of things. But yeah, those are big things that they do look at. Where else? Oh, your car registrations too. That's another big thing. So where you're registering with the state on
Mhm.
those items really tells them like, hey, how do you prove it? It's like, yeah, bills are actually a big one too. So I would always say if you can do your IDs, voter registration, bills, you're generally covered on that side. it's like more than enough proof to show where you're truly living.
I guess the bigger question here is then, is the amount of effort that and time you put in trying to substantiate all this worth the amount of capital gains you're trying to exclude, right? That's the question, right? Because I imagine switching names on utility bills or trying to find documentation and fabricate all that legitimately, it does take some time and effort.
Oh yeah, yeah, it does take some time and effort. But I think if you know that this is like a strategy at hand, and then you can probably just start up a folder if you really wanted to. And just know like, hey, drop in the utility bill for like, hey, like maybe start like a homeowners exclusion folder and then per property. And then
Mhm.
as you go through each one, just drop it in if you want. But yeah, at the same time, like, how much is the capital gain? Can you take the hit? Because like say if you had, I don't know, you bought a property for 600 grand and then sold it for 700, right? And then
Mhm.
fee on 700 is what, 5% generally. Take 35 grand, so 700 minus 35 grand minus 600, and then you spent like maybe 5 grand getting it ready. So your like cap gains like 60. So like maybe on
Mhm.
the side, worst case scenario, it's like 14 grand, and then probably another 6 grand on state if you live in California. So like 20 grand. So yeah, I
Okay.
guess like how much yeah. I guess it's like up to you, right? You need to see, it's your preference at the end of the day. It's like, is all these like documentation worth it for 20 grand, right? In my
Right.
opinion, yeah.
Okay. And so I'm doing a house hack right now. My primary residence is a 3-bed, 2-bath, renting out two of the 3 rooms. And so I took the approach where I'm writing off 66.7% of all my expenses, right?
Mhm.
So if I decide to sell this year or next year, and I have lived in it too the past 5 years, is it a blend of the homeowner's exclusion and a 1031 exchange? So if I want to sell this primary residence and buy an investment property, could I 1031 exchange 2/3 of the um, cap gain and then have a homeowner's exclusion of 250K since I'm single
Yeah, you could
on
do, yeah,
1/3?
you
Is
could,
that how it works?
yeah, you would prorate it towards each
Mhm.
portion that was rented out. So as long as you had that reported on your taxes for the last year or two,
Mhm.
longer the better, of course.
Right.
Yeah, you could definitely, do that in 1031 it on that side. The other way too is just you could just skip the 1030. Some people just skip the 1031, and then you could just buy a unit, run a cost seg against it, and then that helps reduce the capital gains too, anyways. So
Buy a unit?
buy like another property without
Mhm.
going through the hurdles of a 1031 exchange. Because sometimes like you just can't find something in that window of time. So
Mhm.
people just like skip it and then they'll just find other ways to reduce their taxes.
Oh, they don't take the 1031 exchange route. They just completely omit it.
Yeah, yeah, exactly. I've seen some people do that too, just because like the timing didn't work out. There's also opportunity zones too that gives you a lot more time also, like 180 days versus 45 days to identify and defer your gains. So
Mhm.
that's another one too.
Oh, they find ways to either take the cap gains and then find ways to offset it somewhere from another area of their portfolio, or do it like an opportunity zone to defer it.
Yep, yep, yep. That also too, there's other ways to seeing where it's if you got like, obviously it's not great, but say if you're in the stock market and you got losses from the stock market too, you could also sell those bad positions, just do tax loss harvesting, but like on purpose to um go against cap gains also. So obviously you are technically losing money, but it's like if there's stocks that you're like, yo, this is never coming back anyway. So like let me just get,
Yeah.
yeah, yeah, yeah. Like, it's like a second place trophy. Obviously that's why it's not great because you're losing money technically, but at the same time, you do free up capital and you kind of get a tax benefit from it.
Okay. And then
Yeah.
last question, if um if I move out of this primary residence and for the next 3 years live somewhere else and don't come back to this primary residence,
Mhm.
and I sell, so I'll call this property A. Which is my primary residence, if I move out of property A and permanently live in property B for the next 3 years, and I decide to sell property A, I cannot use a homeowner's exclusion, right?
Oh, you did technically live there because yeah,
Oh,
property A.
sorry. Let me make it more extreme.
Yeah.
10 years. If I don't come back to that property and live there for
Oh
10
yeah.
years.
Yeah. You're done. Yeah.
And
Yeah.
so when I sell, is there any portion of the capital gains that I cannot 1031 exchange because I only rented out 2/3 of the house at the time I was living there?
Oh
Or is
no.
everything 1031 exchangeable
Everything's
at that?
1031 at that rate. Yeah, 100% goes back because you would have fully rented out that unit then.
Got it. Okay. That sounds good. Thanks,
Mhm.
Tony.
Yeah, for sure, for sure. I like the creativity here. You could probably come up on a crap load of wealth actually, like or equity wise, because it's like, buy a house, live in it 2 years, move on to the next one, and then you just keep on picking up tax-free gains all the time. So I dig.
Yep.
Yep, yep, for sure. Cool, cool. Good questions, good questions. Anyone else for any questions?
Hi there, Tony. Thanks for the presentation. This is Kim. I just
Hey,
have
Kim.
hi. I just have like a little general questions. Just out of curiosity, say for example, with regards to your cost segregation, if say for example, I've got like a student housing and I were to do that. However, I don't have the professional, rep status.
Mhm.
Is it really beneficial with like other properties being able to drive down my effective tax rate already to say, for example, about 18 to 19%?
Oh yeah, so on the student housing, if depending on how the costs are sitting after depreciation, like normal depreciation, it could be worth it. So it's like, so if I take this one as an example here, is that say if you got actually you want to use your house as example, or you want to keep your numbers private? Yeah.
Sure.
Oh yeah, yeah. What's the monthly that you get on it?
Well, right now I have my son in one of them.
Yeah.
So otherwise it's right now 3,200. However, after he moves out, it'll be probably 4,000.
4. Okay. So let's just take high case, so 48, and then minus I'm assuming insurance 3 grand or so.
No, it is about actually 1,300.
Oh, nice.
Yeah.
Oh, where is he going to college at, by the way? Yeah.
Oh, Sac State.
Next state. Oh, nice. Okay, there. And then property tax, 10K.
Uh, Gosh, it would be about $500 a month. So about maybe
6.
6,000.
Okay.
Yeah.
So 6 and then 6K. And then so we got insurance, we got taxes now, interest. Let's just take a guesstimate on your loan amount and the interest.
Yeah, everything escrowed out. So it'd be about 3,200 or no, actually, I'm sorry, 3,400.
34. So let's just say 34, and just say 80% of that goes towards interest, times 0.8 times 12. 32 grand interest, maybe might be a little bit high, right? Maybe could be.
Yeah, interest rates are kind of killing me, but
Yeah. All right, so minus 32. What I did was just like took your 3.4 times 0.8 to say that's the interest portion.
Mhm.
And then utilities.
Just about $100 a month.
Okay, cool. Minus 1.2.
Yeah, so 1,200.
Okay, so yeah, 7.5 left after like your main things before repairs or anything. So you still have 7.5K here is like everything before depreciation. So yeah, in this example here is that you would have 14.5K already without a cost seg. And then so you'd be negative on paper. So, cost seg may not be worth it in this case. And also if you have other properties that have positive income or positive like losses already because of other depreciation, it would
Mhm.
offset the 7.5K anyways. So in this situation, I think, the cost seg wouldn't make sense to justify it because they're generally like a couple grand. We did find a partner that's like super cheap, but they're still like 625, 675, which is a lot better than the average market rate. But it's like you wouldn't realize a benefit this year with it. So, but if you were a lot more profitable, like Airbnb wise, where revenue is way higher,
Yeah.
then where you have your Airbnb revenue is so high that even with depreciation, like normal depreciation,
Mhm.
you're still positive, then you want a cost seg. So it's always kind of like running the numbers here. But I think
Yeah.
based on like what we just spoke here, and what was the purchase price of the property?
510.
Oh, this is
Mhm.
actually really close to the example. Yeah.
Yeah.
So it's
That's
13.5.
what's kind of curious.
Oh yeah, you're -7 already. Like,
Mhm.
yeah, could you add more fuel to the fire to lock in more losses? Yeah, but is it worth $600-700? Kind of not. If it were me, I would just, save it, because unless your strategy changes in the next couple of years where like, oh, hey, you do plan on selling something or you do plan on picking up some other units that are a lot more profitable. That's the only time I would pay extra money to lock in my losses today.
Mhm.
Yep.
Yeah, we're working on another acquisition, but still,
Ooh, student housing again or no?
no, it's actually a quad.
Oh, quad.
In the Central Valley area, but
Okay.
that's a
LTR,
different animal. What was that?
a long-term rental.
Yes, that'll be
Okay.
a long-term
Yeah.
one for sure.
Oh yeah. No. Yeah. Based off that, it's probably not worth your $600.
Yeah.
Yeah.
I was
Mhm.
just kind of curious because, if I didn't have that professional rep status, can I really utilize that, the cost seg?
Oh yeah. Yeah. I think the only times where a cost seg makes sense
Mhm.
that I've seen it when you're not real estate professional status is that number one, like I said, the Airbnb, STRs, some MDRs actually are that profitable even.
Mhm.
The other one would be if you make less than 150K AGI, because it actually helps you. Reps, short-term rental loophole. Those are like the primarily times you use it. Otherwise than that, like it's generally not. Oh, and then this was rare, but it's usually the where you get the house from mom and dad because
Mhm.
they just give it to the
Yeah.
children, and then there's no mortgage on it, so then they need to accelerate the depreciation. So that's another time where I've seen it. But other than that, I would say that's probably 80% of the use cases actually.
I see. Okay.
Mhm.
All right. Well, thank you.
Yeah, you're welcome.
Hey, Tony.
Sup,
This is,
Stephanie?
this is Steph. Thanks so much for the presentation. I was just wondering, would you be able to send out a recording?
I believe Nelson will, or Annie will. Whoever's computer this store is on, I don't know whose is going to store on, but yes, I think we can send that out.
Okay, amazing. Thank you.
Yeah. Cool.
Hey, Tony, Josh here again.
Oh yeah.
So, piggybacking off of what the previous person that had the student housing in Sacramento mentioned. So, on the cost segregation and accelerating depreciation, and also bonus depreciation, do you need to do that in the year you purchase it, or can you do that later, like in year 2 and onward?
You can run a cost segregation later on, and it doesn't have to be within the current year that you buy the property. So you would have to do you run the cost segregation. There is a form, it's called the change of accounting method, that you need to do. And then either you'll have a lot of hours spent on TurboTax, or your CPA will be like, oh, damn it. Okay, here we go. You got to roll their sleeves up. So yeah, it doesn't have to be within the current year. But for bonus depreciation, it's generally reserved for the year you place the asset in service. So if you want to really take advantage of the bonus side, yes, accelerated depreciation, you can run cost segs whenever you want. You can always go back.
but it sounds like it takes time and effort. It sounds like you have to backtrack and like rewire the way it was accounted for.
Oh yeah, so like mechanically speaking, it is. So you have to take so pre-cost seg, you have everything as 27 and a half year, right?
Yep.
However, say it's year 5, then you're like, oh, okay, cool. Like Tony said, go run a cost seg. All right, cool. No, you're gonna do it. So now you have to take that 27, like say 50 grand accrued. You have to take that 50 grand and shift it into 5-year, 7-year basis, and then redo your 27 and a half year base. So you'd have 3 new buckets of depreciation to recalculate that year. So yeah, it is a little.
It's a surgical procedure.
It's a bit tedious. Yeah. It's definitely not like it's not like putting in a W-2 on payroll tax. It's like, damn it, like bust out the spreadsheets, like lock in for a good hour, depending on how many units it is.
Okay, so my confession is an error that I did in my a couple years ago, since I didn't know much and have much knowledge, was I did cost seg on my property. I'm a W-2, and now I have a bunch of paper losses that are locked in, and because I don't have the real estate professional status or designation, I can't unlock it. So is the best next thing to do would be the short-term rental loophole?
So that piggy bank is with you forever.
I know, but like it's like itching me that it's not unlocking itself.
Oh,
And
got it. Yeah, so that will stay forever. The only other way will be, your new properties would be your STR loophole. They go against your W-2 income.
so that's the best thing to unlock those losses, passive losses.
Oh, they're still stuck. The losses are always stuck within the year that like you had them. So like say you had prior losses, even if you did STR loophole, even if you turned in reps, you would not, that piggy bank's still stuck. Like nothing's gonna smash it. The only thing that would smash it would be your when you sold that property. Then you can like smash that piggy bank and take the losses against the sale against that property.
Oh, I can't like write it if I have a real estate professional designation status. Can I take passive losses and write it off against my active income? Is that what
Within
it
the
is?
current year. Yeah, within the current year. So say if you had, so in my example here, say if you had negative 24.8K of losses, that offsets your W-2 income if you have real estate professional status. Let's say in the past 2 years, you had, 50 grand locked in, that 50 grand still stuck. You're not unlocking that 50 grand with the real estate professional status.
Oh,
Yep. It's always like you carry in the current year losses against your W-2.
got it.
Yep. Yeah. And then that, and then another like slight version of this too is there's so some W-2 folks, it's like not 100% real estate related, but since it sounds like you are on the W-2 side, let me stop share for a second. Let me pull up an example just to run it here, since it sounds like you're in that stuck part right now of
Yeah.
like W-2, but you got some rentals, but you're trying to reduce it. What's his name? But let me find it. So here, Manny, and then show you guys an example of the last 5 minutes that we got here. Let's see, this. Okay, something to consider. Let me share screen again. All right, so as a side note, detracting a bit from the real estate side, but we're here all to save money because that's what we do, is investment tax credits. So these are solar credits at the business level, not the stuff you put on your own primary home. But in this example here is that you're buying solar light poles. And here once again, we're using that whole depreciation purpose, but you tossed in 135 grand as an investment, you would get in year 1, you would get about 37 grand of depreciation against your W-2 income, and you get 54 grand of tax credits, and you get $6,000 of income stream, like rent, but you're getting paid for your solar light poles. So something alternative investments, if you can't lock in a deal, I know it's like coming up on Q4. It's still a great time for everyone to like deploy strategies. But if you can't get your STR loophole in the way and you're like concerned about your W-2 income, alternative tax tip for you here.
All right. Thank you.
Yep. Mhm.
I think we had a question in the comments.
Oh, question in the comments. Let's see here. First year federal special depreciation, What are your thoughts? Oh, that's a code where, so special depreciation allowance is aka bonus depreciation. Yeah, so it's just different terms that people use, but yeah, that's what that translates to in like layman's terms. Fancy tax jargon. It's like tax loss harvesting. I don't know why they call it like tax loss harvesting. I'm like, dude, it's just selling in bad positions and capturing your capital losses. So like I said, like earlier, it's, literally our method is the KISS method, keep it simple. That way. Yep. You're welcome. Cool. Well, any last questions before we're done for the night?
Are you based in California?
Yep. Yeah, I'm based in the Bay Area. Where you got yourself?
Hayward.
Hey, not too far. I'm in Richmond, man. Yeah.
Hey. All right.
I'm sure Annie will drag us to the Friendsgiving if she's doing that again, or whoever's house got volunteered. Maybe we'll run into you there.
All right. For sure.
Nice. Cool. All right. If no one has anything else, forever hold your peace. You got questions, post on the Facebook SARE group. And then, yeah, thank you everyone for tuning in tonight. And then, yeah, we'll pop out that presentation to y'all.
All right. Have a good night, Tony. Bye.
All right. Take care.